Hey viewers, welcome to today's session. Today is 28th of February 2025, Friday. Last and I was missing in action from trading for some time because I had a lot of my other work to do, my day job, as well as the market was not that conducive for trading because either it would remain very sideways where the premiums would dry up or there would be sudden moves on the downside as you would have seen. So I've been staying away from trading for much of this February month, other than the first week or two where I did make few trades. I have been very inactive in the February month. But this time I did utilize to invest to enter new positions in stocks and mutual funds. So that is what I wanted to talk about and share with you guys today. But before we move further, just a disclaimer. So all these videos that I'm creating, the content in it and what we're discussing, right? It's not a recommendation of a particular trading style or an investment style, nor is it a recommendation of any particular stock or a company or mutual fund. What I'm saying is my journey I'm sharing as an information that can be used so that it can be informative for my viewers and it can help my viewers take a decision in their investment and trading journey as well. But as such, I'm not affiliated with any of the products or any of the companies or the mutual fund houses. That's one disclaimer. So with that, let's get into this video. So today on the 20th of February, there has been a lot of down move in the index. You see, Nifty fell almost 2%, same with the Sensex as well. So there are a lot of reasons for this. One is at a macro level, globally, US may impose reciprocal tariffs, and so there's a lot of negative sentiment, as well as already in Indian markets, foreign institutional investors (FIS) are continuing their selling spree, and there's very little that the domestic investors can do to compensate for it, as well as the broader index is still kind of well, it's still uh, above its historical average in terms of the forward price to earnings ratio. But this down move did give us a good opportunity today. So I am a person who likes to wait for opportunities and then grab them. I do not buy the idea of deploying all of your capital when the markets are in continued bull markets where valuations are very high, PE ratio is very high, and you deploy capital there, then there's a risk that in the midterm, right, you will see a capital erosion. So I like some market corrections, meaningful corrections. I'm not saying we'll have to wait for a crash, may or may not come. If you keep waiting, you may never be able to enter a market. What I'm saying is some meaningful 5%, 10% correction from the all-time highs happens. Maybe that is time where you start investing more and expanding your positions in the equity space. And another strategy that I follow is I do not deploy all of my capital in one go. When we have a falling market or a sideward trending market, so we do not know when the current market will bottom out, right? So already as of today, the market is 15-16% down from its all-time high. From here onwards, so a lot of people say it can still go down, but the downside is limited from here because this is the first time that we are seeing such a big correction happening on the negative side, downward side over a period of many months, right? When compared to last 5-6 years, this is the first time such a prolonged downside movement is happening. So people are saying, a lot of them, that the downside is limited. It may be true, it may not be true, but whatever happens, we need to ensure that in whatever the case, we do not incur big losses. So even after the initial significant fall of at least 10%, I still take a staggered entries. Say for example, from there onwards, every 2 or 3% fall, I deploy an additional capital of say few thousands of tens of thousands of rupees or 50,000 rupees or something, right? So that is what I do upon every 3 or 5%, 2 or 3% fall below 10% mark. That's what I do. So when I do this, what happens is one is like price correction, and second we need to know about is the time correction, correct? Not only does the price move down from the current value, but also over a period of time, price varies. So I get more time to deploy the money at relatively lower levels compared to the peaks. So that's why I like that approach, and that's what I am doing. So let's see the overall index movement since the all-time highs in 2024 September. Let me go to the weekly chart. What we're seeing is from September, from 26,250 to coming down to 22,100 in the month of February, right? Within this 5 months, has been a significant down move of more than 4,000 points or 15-16% down move from the peak values, right? So it's not that you have to blindly close our eyes and keep continuing investing about capital, what do we have, whenever the market on that day, whatever the price it is. That's not is required. Because if we just kept doing blind investing, right, since the month of October, November, December, correct, or even the few months before September, like August, July, so I'm sure all of that capital wouldn't give us any positive results. In fact, the returns would be negative. So when the price to earnings multiple P earnings of Nifty is very high, so it reached a peak of 25 or 25 plus, right? In the month of September 2024. So we waited until it cooled off to say below 22 and a half, 21 and a half mark. So that is the overall top-down approach I'm taking. So top-down in the sense, first you see the valuations of the entire market, the Indian market, and you see is it overpriced, overvalued, then you may want to see until it has done some decent correction. You may not get a lot of correction always, correct? But a decent correction is like P multiples have just reached around the historical levels, at least, if not lower than that. And then you start talking about questions like which asset you need to allocate more, large cap, mid cap, or small cap, right? We want to go with mutual funds or equities, direct equities, or exchange traded funds. So all these are macro questions. Right? So top down is what you go, and then you look into the particular sectors. You want to play the cyclical sectors or those sectors which are kind of valued decently or undervalued at this point of time. And because of the crash, more than half of the listed companies have declined by at least 20-25%. So there are a lot of value stocks available out there. So that's how you begin at the very top macro level, market, entire market level, and then you sequentially consider more and more of these options. That's the approach I have taken. With that, I will show you what my current positions are. So this is what my current portfolio looks like. It is a portfolio that is still under construction. I'm entering into more and more positions as the broader indices tend to fall or lower or even remain sideways. I'll walk you through the components of my portfolio that I'm constructing, what companies I'm investing in, what stocks, and even ETFs that I am purchasing and buying these days. And as I said, since I'm looking into a top-down approach, so first I'm starting with asset allocation. That is my first level of criteria. So I'm taking exposure mostly to large cap companies and ETFs, and to some extent even the mid cap, and to an even smaller extent small cap companies. And within the large caps and the mid caps, I'm playing both the blue chip strategy as well as value proposition, where blue chip is the largest of the index listed stocks by their market capitalization, and within those Nifty 50 funds, those companies where the value current valuations are attractive after the significant fall that most of them have had, correcting by at least 20 to 30% or even more than half from their all-time highs in September and October timeframe. So first, I'll just scroll down my portfolio. I have total of 22 holdings, 22 scripts. We'll see what they are. But first, we'll look at only the large cap stocks and the large cap funds I'm investing in. The first one is Axis Bank. About 4,000 is my exposure there. And then HDFC Bank, 2 shares around 3,000. Then ITC from the FMCG. Then LIC Life Insurance Corporation, playing on the insurance, about 7,000. And then I also have an index ETF, large cap Nifty ETF, Nifty Bs, 40,000 is the total investment I made over a period of time, averaging out across every significant fall, right? From 10% to 11% fall, 11 to 12%, and so on, all the way till recent today's Feb 28th fall, right? So 40,000 total. And then Reliance, about 6,000, and State Bank, about 9,000 there, playing on the PSU banks. And then Tata Motors, around 6,000. So there has been a significant fall there. A good value proposition again here. And from IT, I'm getting on TCS, a couple of stocks, like in 7,000 rupees. So that is how I'm playing the large cap sector, about the fund, ETF, the Nifty Bs, as well as few of this large cap stocks across sectors, primarily banking sector, private and public sector banks, then FMCG, and one auto stock as well in Tata Motors. So most of this, because they have fallen significantly, the PE, price to earnings ratio, forward looking for the next 1 year, has significantly corrected. How I selected these was based on, I keep reading articles, so it's not like blindly reading articles and following the recommendations, but I read different articles from different publishers, and there are names that are common across different brokerages, right? They all do independent assessment, and after that, further, I do my own assessment of the companies. I go look up their current valuations and future potential from here onwards, right? You can always go and look into Screener to get their technicals, but also if you keep following these companies, if you keep studying them, then how their earnings are expected, how the business is going to play out in the future, right? In the very short term, there could be downsides, there could be headwinds, there could be challenges in the businesses, but due to the nature of the business and the domain they are into, and the market capitalization and the market share that they have over the competitors, the future should look good. So I take all of these factors into consideration: value-based investing, fundamentals of the company as well, and everything. So now let's look at the positions in the mid-cap domain. I have one specific company, GIC Housing Finance, which I recently entered. Total exposure is about 4,500, and then I'm also investing in an ETF fund, a mid-cap ETF fund. Total exposure here is about 21,000. But one caution, though the Nifty 50 index, the company is listed on the Nifty 50, the topmost 50 with their market capitalization, they have declined and their valuations have come down to the historical levels or even better. The same is not true for the general mid cap and the small cap space. While there could be a few number of mid caps and small cap companies which have really corrected well, makes sense to look at them now based on our future potential, but it's not the case for the broader mid cap index itself or the small cap index itself. So I'm not betting too much and one go on the index as a whole, mid cap index as a whole. This is why you'll see that where I have taken positions in multiple, right, more than 5, 6, 7 large cap companies. I've taken position only one mid cap company, and GIC Housing Finance, and also where I had entered a position of 40,000 plus in Nifty Bs, the large cap, the ETF. My position in the mid cap ETFs, if half of it, about 20,000. This is also after a lot of averaging over multiple sessions of buying. It's not a one-time investment. So that's the reason you see that my total mid cap ETF is down by 2.5%, right? Even though the mid cap has fallen a lot recently, over the past 5 months, almost like 20% correction has happened. And since I started investing, about 5 to 7% correction has happened. But still, my portfolio is like only 2.5% down. That's because I've been averaging it out. I've not been purchasing in one go, but entering positions in tranches, multiple tranches. So that's my overall exposure in mid cap space, right? In my this current portfolio, that's what I have. And next aspect I want to talk about is the small cap sector. So in small cap, I have taken positions in both the larger sized and the mid-sized small cap companies, as well as the small cap ETF. So this is another exchange traded fund. Small cap ETF is there. I'm avoiding the very small caps or the micro caps for now because I'm still doing my assessment, and probably it will take some more time for me to finalize and make up my mind, and also let the price correct even more from here, where it becomes even more attractive, because about the small cap and the mid cap are still trading at a premium index as a whole when compared to the historical averages. But I'll just walk you through companies I have taken positions in. The first is Oral Chemical. Still, the valuation is very high in this, and there are some question marks onto the immediate next few quarters. But still, overall, the long-term fundamentals are dependable here for me. So I've not taken very big position. That's the reason you should see it's about 900 is my total investment here. That too averaging over multiple days. And correct, even with that, also with all of that averaging, also I can see that my current portfolio here in this company is negative 5%. Making wealth from small cap, you should not have that mindset and invest a significant part of your portfolio if you end up in investing small cap. Then when there is a downturn, where then there's a huge downturn in small cap, right? In front of your eyes, it's very easy to go to negative 5, negative 10% even after averaging. If you do one-time investment, then every single day you will see negative 7, negative 8% in each and every of these individual small cap stocks. And the worst is there's not much of a liquidity. So if you're just caught up in a position, you want to exit also, you cannot do it because there's no going to be any buyers because of a small liquidity that the small cap space offers. The next one is DDEV Plastics, around 2000 what I invested. Again, this has a solid outlook. So how I invest, as with all of the large cap companies, I keep track of even the mid cap and the small caps, and particularly small caps which are kind of having a good future based on the domain they are into and the market share they have, potentially how much their market share can expand to. So those are a few of the criteria. At the same time, all of these companies are also like decently valued in terms of their PE multiples, price to earnings ratios. So on one hand, small cap space is like very expensive, right? At the peak, it had PE multiples in excess of 30s or even hitting almost 40s, right? It has declined since there. It's down to around the higher 30s or even at high 20s. But the stocks I have selected within this space, right, be it the mid cap or the small cap, are trading at PE multiples that are significantly lower than that, somewhere around the index's average PE, or when compared to their peers in their domains, they are at the lower end of the price to earnings ratio. So not high on valuations. So these are decently valued, well valued, and we'll just have to ensure that we take a decent position side over a period of time, so we don't apply too much of a capital in a single go. So there may be more corrections, then we can get to purchase the shares at an even discounted prices. And then next one is Moltech Packaging, and here a total of 4,500 position in this small cap. And going further, Morpen Laboratories, a position of 2,500. And then moving on, Railtel, a capital of 1,700. And then Sanghvi Movers, a total exposure of around 4,000. And then you can see there's a small cap ETF also that I hold, but at a price that is lower than the mid cap allocation. So mid cap, we just saw a total exposure of 20,000 odd, whereas a small cap is 16,000 something. And here also, if you see, my current portfolio is down by 4.75%, less than 5% is down, whereas the broad small cap index itself is down by at least 7 or 8% during this time since I started buying the small cap ETF, the index, and the two accounting for the negative 2.5 returns on this one day. So we're doing better than the broader index because of our staggered approach. And then a company called as Tara Chand, about 1,500 into this. And lastly, Uniparts, about 2,000 is invested in this one as well. So net, if you see, this is what my current positions are. And I forgot to tell about the position I'm taking in gold as well. Not a big position. If you see, I'm just starting to take positions because gold is at an all-time high and it is kind of starting to fall. Right, there has been like about a 2% correction from the all-time high. So I'm just purchasing in small tranches. About 500 is what I've invested in the position I've exposed to gold base. So like again in a gold based ETF. So that's how my overall positions, if you see, I'm diversifying, and what I'm doing is asset allocation across the market capitalization, large cap, mid cap, and the small caps. And within all this, I'm having both direct stocks of the companies and also ETFs. I like ETFs because they incur very less transaction costs, as well as they follow the respective indices directly. And the individual companies that have been selected have been based on both their strong fundamentals for most of them, as well as currently they're all trading at a good valuations. They're not that expensive. So this fall, instead of being at the receiving end and being a victim of this market crash, I'm using it to my advantage. I'm accumulating some good names so that from a mid-term to a long-term basis, when the market improves and when the stocks and even the company's earnings improve over a period of few quarters from here for the next remainder of this year as well as the first half of the next year, calendar year, we should start seeing at least decent returns. We don't know when the market will rebound, or it may remain sideways, or the future market may be one which is basically sideways, but we get some small rallies, but those rallies kind of correct after some time. They kind of cool off again if the market remains sideways. So whatever it is, short term that is what it can be, but in the long term, definitely, because we are considering the fundamentals of the company and their current decent valuations, the next say 5 years, 7 years, or even 10 years, these companies are only going to grow from where they are today, and which means the stock price is going to go up relatively, and which means our portfolio is also going to go up. And because much of our portfolio is selected based on these criteria, we should see our overall portfolio doing good as well. Here is where I'll probably tell one more thing. So your portfolio should be manageable. It should not be too big. Even the number of positions I have now, right, 22, which of course includes 3 ETFs, large cap, mid cap, and the small cap ETFs, and one gold, right? If I take them away, I will have 18 stocks in total, right? 18 different companies across market capitalizations, large caps, small caps, and one mid cap. So if you go by an average person, even this number is on the higher side, something like 18 or 20. It's recommended that to have a portfolio that is manageable, you have not more than some 8 to 10 or maybe a maximum of 12 stocks. It becomes easy for you to track, right, individual companies, because you have to be constantly watching out for all of them. Because if you have invested your money, it's like you have your skin in the game. So you need to follow how the business is doing, how the results are playing out, what strategies the company is taking, what is the guidance that the management is giving for the company. All of this becomes very important, and if you have a very large number of them, it becomes difficult to constantly track all of them. So for me, kind of used to this, though it's on the higher side. Somehow I make time to ensure that I'm in touch with the companies and have a sense of where they're going, where the business is going to trend from here onwards. But I would not like to increase this further beyond, right? So it's 20 odd something now, right? Might be a maximum of another few more companies. What I may add to my portfolio as a whole in the long term. But I don't want it to grow beyond around mid 20s or higher 20s. That's the highest I can do in a meaningful manner. Unless I may add some stocks or funds just for the sake of tracking, correct? Where the particular sector or the company is going, I may just add them for the sake of tracking, not for actual investment purpose, in which case you can just kind of ignore those. But this is how my positions look. In one of the broker, Zerodha. This is Zerodha broker, and similarly, I want to show you positions I have taken in another broker, Upstocks. So I have positions taken in through both the brokers. One is Zerodha, about 1.5 lakh, and through Upstocks, I have a position of total position 42,000 something. So overall, direct equities, I have about 1.9 lakhs as of today, after averaging out and starting after a market fall of by negative 10%, and from there onwards, for every 1%, I've been deploying some capital that I have in the fundamentally strong and well valued companies which are not very costly. And in this portfolio that I have on my stocks broker, it's mostly you see ETF funds, right? Once again, Nifty Biz, which is like 31,000. A major share of all my investments in Upstocks is Nifty Biz, and then small cap ETF around 6,000, and then mid cap ETF which is around 4,000 rupees. And just have one stock here that is from Axis Bank, that's around 1,000 rupees. So the reason why I prefer Zerodha over stocks is because of the transaction cost. Zerodha does not impose brokerage costs for buying your stocks or ETFs. Of course, there is your security transaction tax, STT, and few other charges, but are very small, very minuscule, right? So this total of 1.5 lakhs that I purchased in Zerodha, it might have cost me about 100 or maybe less than that also, maybe just above 100, that's all. But the same thing, if I had purchased swap stocks, it easily would have taken me few thousands of rupees, right? Like 1% of my overall capital deploy will go in brokerage and taxes itself. So that's the reason I will still stick with the Zerodha, because I am an investor who likes to be cautious, err on the side of cautiousness, and make use of the opportunities whenever there is a downside in the market, and then keep taking more and more positions, sequentially more positions when there are more downsides. So if that is the case, then I'm going to purchase a given company not single time, but I'm going to do that over multiple occasions. Every single time, if there is a brokerage, then that's going to eat up into my returns significantly. But I still have some position in terms of mostly ETFs of having a single, but I'm still diversifying and having Upstocks as my second broker, because I don't want to face the risks of having a single broker, right? For example, if Zalata is down, I am kind of shut out from the market that day, right? I want to enter new positions because there's a market downturn there, or I want to exit position because I want to see a change of portfolio. I cannot do that if I have only one brokerage account. So that's how my complete overall portfolio looks like. I wanted to tell you for your awareness, because you should also think of me as not someone who just talks and gives from free advice, but also as someone who acts on that advice, right? I am deploying my own money, right? My mouth is where my intentions are, and kind of bring out to the world, to the viewers, I'm kind of showing that I'm following the very advice that I'm giving with my own money as well. And at the same time, the intention is you can see the basic approach, correct? So there is a lot of market correction, and people in general will think like, what will happen? Should I stay with the market or exit the market, or should I enter now, right? So in the very long term, you have to see the picture, and if you stick with companies that have good fundamentals and that are like valued decently, good companies at decent prices are better than waiting for getting ordinary companies at a very cheap price, right? And now I want to take you through my mutual fund portfolio. We just saw what my direct equity investments are right across the market segments. I want to do the same thing from mutual fund as well. So I'm investing with Access mutual funds, and there are two folios as you see. But the first folio is a debt mutual fund, so we'll just keep that aside for now. The one that is listed below, right, is the one that is for equity. Let's look into that. So if you see, the total investment in this folio is 99,000, almost 1 lakh, and in that, how the split is 37,500 is in value funds and 31,000 is in blue chip funds. So both of these are predominantly large cap funds, which means 69,000 of it is predominantly in large caps. And then I have about 30,000 in mid cap fund as well. There's no small cap. I'm investing in through mutual funds because I already have a small cap ETF on my brokerages. That's the reason I'm not buying another small cap fund here, whereas I am buying mid cap here in this case. And out of a total investment of around 1 lakh, as you can see, a majority of it, close to 70%, is in the large cap space itself, and about 30% in the mid cap space. And within the large cap space, about half of it in a value fund, which are large caps mostly with a decent valuation, as a high potential of appreciation from here onwards, and remaining are about 31,000 in large cap blue chip funds. So the way I do this is, whenever there's a significant market fall of around more than 1% or 1.5%, I buy lump sum, in the sense around 3 or 4,000 rupees in each of these mutual funds, as well as I do very regular SIPs. SIP installments for me, they run pretty much on daily basis or a weekly basis. So I control the SIPs where the market is trending high or sideways. I kind of cut down the frequency. If the market is going down, then I increase the frequency and do it on a pretty much on a daily basis. So every day about 500 or 1,000 is what I keep on investing, and average down the cost of acquisition for the units, so that the average NAV comes down overall basis. So if you see, that's the reason my overall portfolio is around 92,000 against investment of 99,000, which is about 6.5% down. The same is the case across value blue chip fund, though the correction is On the negative side, about 6% is still less than the 16%, 15-16% that index has come down, right? As a whole, the Nifty 50 index, which is primarily large cap index, has come down by 15-16%, but still our portfolio is down only by 6.5%. That's because I made the initial purchase of around 60-70,000 when the index was down about 10%, and from there onwards I've been buying mostly on a SIP basis, and whenever there's a significant correction on those days I enter additional positions of about 3 or even 4,000 and so on. So that's how, even in the mutual fund space, I kind of average out. But again, I'm playing in a conventional sense, mostly blue chip I have as a core, and then I'm going with a value fund as well. Again, the value fund is having large caps as its major components, and then of course mid cap fund, which is like not more than 30% of my portfolio. So net, I have total investment of about 1.9 lakhs, close to that amount in direct equities, and about 1 lakh in mutual funds, a total of around 2.9 or close to 3 lakhs that have accumulated after a 10% downside in a Nifty, and from there onwards periodically I increase my positions slowly over a period of time for every certain percentage points of fall from there onwards. So viewers, if you have any questions or any thoughts, you can drop your comments on this video, or you can share your thoughts over the email that you will find under my channel's description. I hope that was a useful video for my viewers. So please subscribe so that I can bring you more content on similar investment topics. Thanks for watching. Until next time, bye.